Hello everyone, I hope you guys are doing well and your studies are going in full swing. So welcome to the last and the final session for your new questions on new concepts, the AI driven questions that we are doing. And here this will be a relatively shorter session and we'll cover the two of the most important areas, that is derivatives and interest rates, along with a few other theory topics like securitization, startup finance, etc., on which also we have tried to formulate a few questions. So let us get started. Now, when we come to the section on derivatives, there are a few things on which numericals or a MCQ based case study can be done, which is the special types of options, like the exotic options. We would have discussed this probably along with your theory, but maybe the numerical part over here may require some bit of working, like there can be barrier options, there can be Bermuda options, there can be Asian options, etc. Also, certain other credit derivatives, most notably credit default swaps, which has come once in the MTP, but can also come as a part of a numerical, and also some special derivatives like weather derivatives, electricity derivatives, etc. So real options is something that has been coming very often and it is based on the questions which are there. However, for these particular points, there really are not as many questions. So we will try to review these and a couple of other additional points. So first of all, you have weather derivatives. Like, what do you mean by weather derivatives? Now, these are derivatives where the underlying is the weather. Now, weather can be a temperature, weather can be, let us say, units of rainfall, etc. Now, insurance protects you against significantly big natural calamities like an earthquake or a cyclone or something like that. However, if there is a change in the units of rainfall or in a temperature, the insurance contracts will typically not protect you, and as a result, for such protection you might take a derivative where the underlying is a weather. Like, we have formulated a question over here where your underlying is a weather. Let's say the temperature is the underlying, and depending on whether, let us say, the temperature moves in your direction or against you, the option can be exercised. So over here we can look at a question with the weather as underlying. So let us review this once. So there's a company, Cool Beverages, manufactures soft drinks. The company earns maximum revenue during the summer season. Well, it is hot and people will have more soft drinks. You should know it is not really good for your health, but nevertheless, if you have to now survive, maybe we'll need a Red Bull if we have to go through our CA exams, right? Whatever it takes. If the summer is cooler than expected, the demand for soft drinks falls significantly, adversely affecting the sales volume. So if the temperature is low, people might not drink as many soft drinks, and hence we want protection against that temperature change. To protect itself against the weather risk, you purchase a weather derivative contract with the following period. The reference period is April to June. The weather station is the Indian Meteorological Department of Ahmedabad. The weather that is published. The benchmark average temperature is 40 degrees and the contract settlement is 2 lakh for every 1 degree by which the average temperature falls below the benchmark. So if the temperature is lower than 40, we are worried that our sales will fall, and as a result we have taken a protection in the form of a weather derivative. The maximum settlement amount is 20 lakhs and the premium paid is around 3 lakhs. If at the end of the contract period, the IMD certifies that the average temperature during the period was 35 degrees, so that is 5 degrees lower than, let us say, your strike temperature. So the benchmark average temperature is 40 and we have been told that 2 lakhs for every 1 degree reduction below 40. Compute the settlement amount receivable under the weather derivative. So maybe 40 degrees minus 35 degrees, so that is 5 degrees, and the settlement amount is 2 lakhs for every degree, and hence this will be 10 lakh rupees. So settlement amount in the first case would be around 10 lakhs. Perfect. We will receive. Compute the net benefit after considering the premium. It's like the net payoff. So over here, the maximum settlement is 20 lakhs. Now, this is within 20 lakhs and the premium over here was 3 lakhs. There's no discount factor given. So we just have to find like the net payoff. So this will be 10 lakhs minus 3 lakhs, which will equal to 7 lakhs. Okay. Then you have subpoint C. Suppose instead the average temperature during the period was 41 degrees. What would be the settlement amount? Over here, it seems to be like an option contract. If you see the settlement terms, it is 2 lakhs for every 1 degree by which the temperature falls below. Which means if the temperature goes above, maybe, I mean, if it was a forward contract or a future, you might have to pay. But in this case, maybe it seems to be a clear case where you are only getting a receipt if the temperature falls below, and hence you are paying the premium. If it was a forward contract, usually there is no concept of a premium. So if over here the temperature rises, in this case there will be no settlement, but well, that's in a way good for your business overall, where maybe more soft drinks can possibly be sold. So in the second case it is 7 lakhs, but if your temperature goes to 41, well, the settlement amount will be nil, and there will be 3 lakh rupees that you still have to pay as upfront premium, and that will be your overall loss. Briefly explain how a weather derivative differs from an insurance contract. As we discussed earlier, insurance contract is only helpful in case of major natural calamities, but it does not protect from, let us say, regular weather changes which may adversely affect your business, and hence weather derivative gives you that protection. And in insurance contract, you have to show exactly the loss which is suffered. In case of weather derivative, you don't have to really quantify or show the loss which is suffered. The settlement can happen nevertheless. Okay, next there's electricity derivatives. Now, frankly, there is electricity forward, futures, or an electricity option or a swap. The working is going to be exactly the same as if it is a regular, let us say, forward on a commodity like a copper or a gold or a silver. It is going to be exactly the same, or even let us say a regular forward contract. However, there's a special contract called as a, or a special case called as an electricity locational basis swap. Now, what does this mean? Well, if you are worried that the price of electricity, like you are a consumer or you are a seller, whatever, you are worried that the price of electricity might rise significantly, in which case you can seek protection by entering into a forward contract or a futures contract. Simple. However, when you go to the exchange to buy a forward contract, maybe that forward contract is on a particular uh, underlying of a particular location, let us say for example Western India. However, you are not operating in Western India, you are operating in some other place where the electricity rate can be different. Now, in order to get that protection from the difference between the rate of, let's say, the reference rate of the Western Indian Energy Exchange as compared to the rate in the location in which you operate, you might enter into a locational basis swap. So over here, if I just review a question, ABC Steel purchases electricity through the electricity futures contract traded on the power exchange. Like Indian Energy Exchange is one exchange where you can buy such futures. The future contract is a reference to the electricity prices prevailing in the Western Power Exchange. So let us say that is a reference rate. However, you are not operating in Western India. Then what? The company's manufacturing plant is located in another region where electricity is actually purchased at the local spot price, which may be different. And for this, you will take electricity locational basis swap. Due to transmission congestion and regional demand supply conditions, the local electricity price may differ from the exchange price. Now, you have taken protection from the electricity price through a futures contract. However, that helps you kind of take protection from the price as per the Western exchange. You're not operating there. So the difference, that is like the basis, that is protected through the electricity location swap. The finance manager is considering entering into an electricity locational basis swap. Which of the following best explains the primary purpose for the electricity locational basis swap? To eliminate the overall movement in prices, the answer is no. That is usually going to be done by a futures or a forward contract to hedge the difference between the electricity price at the reference exchange and the electricity price at the actual delivery location. This, I think, is the core objective of the electricity locational basis swap. To convert floating electricity prices into fixed to eliminate counterparty risk. No, these are not the objectives. Point B should be your right answer. Okay. Next, you have this credit default swap, CDS. I think in November 24 case study number 1, we would have discussed in the MTB, there was a question on CDS, credit default swap. And on similar lines, there is a question over here that we have tried to make. Now, what do you mean by credit default swap? A CDS is basically an instrument where if you are buying a bond, or if you are, let us say, a lender, you are worried that what if the issuer or the borrower defaults? Now you have no protection, and as a result you take protection from, let us say, a CDS writer, a credit default swap writer, who will charge us a premium, and against that we will have to, let us say, we will get protection from a credit event like a default. So if a default happens, then it is the responsibility of the CDS seller to pay and compensate the holder for the loss that they've suffered. Like for example, if let us say I had purchased an ILNFS bond, thankfully we did not, but let us say if you had purchased bond of a company like ILNFS, which actually defaulted, it was a 100 rupee bond, and I have no protection. So if let's say this company defaults, well, I will bear the loss. However, if I've taken a CDS, in which case I might have paid a premium, maybe that premium is a percentage of the bond value. It may be paid upfront, it may be paid based on, let's say, the years. Remember, CDS is not an exchange traded contract, it is an over the counter one-to-one contract, and as a result, it may be negotiated. So let us say I have paid a premium, and against that I get a protection. So which means if, let us say, the ILNFS company defaults, and on the 100 rupee bond they're on liquidation paying me only 20 rupees, which means for the remaining 80 rupees I can seek compensation from the CDS seller if there's a cash settlement, where I will just tell them that, well, on this bond I should have got 100, I'm getting 20, so remaining 80 you have to pay. Or there can be a physical settlement where I will give that bond to the CDS seller. I will say, now it is your lookout, you manage with ILNFS, you pay me the entire 100 rupees. Either ways, in the first case, I keep the bond, I take the net 80 from the CDS seller, 20 I will get from, let us say, the issuer, so I get my 100. Or in the physical settlement, I give the entire bond to the CDS seller, I get 100 from them, and then the CDS seller and the borrower will do their own arrangement. So over here, CDS is a credit default swap. It is a type of a credit derivative where the underlying is, let us say, the credit worthiness of a particular issuer, and if the issuer defaults, then the seller will have to compensate the holder for the default. Obviously, if the issuer does not default, then the seller enjoys the premium that they would have received. So over here, when I look at a credit default swap or a CDS, Alpha Bank has granted a 5-year loan of rupees 200 crores. Granted a 5-year loan of 200 crores to Zenith. Okay, so I think this is a lender, Zenith is a borrower. To protect itself against a default risk, it purchases a CDS from Secured Insurance Limited. The terms of the CDS are: notional principal is 200 crores, one-time upfront CDS premium. You might get a question where instead of upfront, in my opinion, practically the premium is paid annually, but let's say if it is given upfront, we take upfront is 1.2% of the notional amount. So this is 200 into 1.2% will probably come to around 2.4 crores, which is the upfront premium. Settlement will be on a cash basis, that is on a net basis. After 2 years, Zenith defaults on the loan. A credit event auction determines that the market value of the loan is just 40% of its face value, which means 200 into 40% I will recover. That is the remaining 60% I will get from the CDS. So this is around 120, which is the settlement value. Calculate the upfront premium payable by Alpha Bank. I would say this is 2.4. Calculate the compensation receivable under the CDS. I would say this is 120. Calculate the total amount ultimately received by Alpha Bank after considering both the recovery value and the CDS settlement. I will get 80 from, let us say, Zenith Bank. Remaining 120 I will get from the CDS seller, and hence 200. Apart from that, I must have paid a 2.4 premium, and hence ultimately I will end up recovering around 197.6. How would this differ if the contract had a physical settlement instead of a cash settlement? In which case, what would happen is the Alpha Bank would transfer the loan entirely to Secured Insurance Limited, and against that they would pay the entire 200, not just 120. They would pay 200, but then Secured Insurance will recover, let's say, 80 from Zenith Limited. So in the first case, 2.4 is a premium, 120 is what you recover. Basically, ultimately 80 plus 120, 200 is the recovery with 2.4 of the premium. And in case of physical settlement, the CDS seller will pay 200 crore to Alpha Bank against the entire loan being transferred in their name. Okay. Then there are a few exotic options, and for exotic options, let us say, well, see, your regular call and put options, which are called as plain vanilla options, are, options where there is a single exercise price, spot price at expiry will be seen in case of a European options, spot price at the date of exercise will be seen in case of an American option. However, there are certain special types of options, like there can be a chooser option where the holder can actually choose later whether he wants to treat this as a call or a put. Again, this is a valuable option for which the premium might be relatively higher. A compound option is like, in a way, an option to buy option at a future date. I'll again repeat, it is an option to buy option at a future date, which is called as a compound option. A barrier option, also called as a knock-in, knock-out option, will only be activated if a barrier or threshold is crossed. If during the lifetime that threshold is not crossed, then the option does not even start. So in a barrier option, it will be activated only when the price reaches a certain amount during the predetermined period, irrespective of what will be the spotted expiry. And binary options or digital options are binary, as the name goes. They will tell you that if a particular event happens, then you will get, let's say, 50. If it does not happen, you'll get nothing. So like when we calculate the payoff under an option, we compare the spot with the exercise price, and then we find, however, if let's say it is a binary option, if let's say the specified event happens, you get, let us say, the agreed amount. If it does not happen, you get nothing. So it is one of the two possibilities only. Asian options, I would say, are important, and there can be a question on this. Like European options consider, let us say, the spotted expiry. American options consider the spot at the date when the exercise happens. Asian options, on the other hand, consider the average price. So the payoffs are determined based on the average price of the underlying, and not just European taking the spotted expiry, American taking the spot at the date when the exercise happens. Asian options will take the average price. So this is an interesting thing which we will review. Then you have the Bermuda options, where see, the American options again will be exercised anytime. European only at the time of expiry. Bermuda, like when we look at mutual funds, you had open-end fund, closed-end fund, and then we had an interval fund where there will be specified dates when the fund can be open. In a similar way, in Bermuda fund, there will be specified dates which will be specified when the option can be exercised. Is restricted to certain dates or on expiration. Then there is basket options, where the underlying is a basket like a Nifty 500 or a basket of securities rather than a single security. Spread options have underlying as the spread, that is the difference in the prices of two underlying, which will be taken as the base. And look back option will be an option where the exercise price will be decided by looking back at the earlier let's say price pattern, and whichever you think is the most favorable, like in a call option the lowest, in the put option the highest, can be taken as the exercise price. Option holder can choose the most favorable strike price depending on the minimum or maximum price during the time period. So these are a few exotic options based on which we have tried to formulate a few questions. Remember, the solutions will remain broadly the same, just that these options might result in, if you are aware of these terms, you will be able to solve. Like Asian options. ABC purchases, cancel the European word. ABC purchases is a Asian call option. It's a call option, but in Asian. On a commodity, the strike price is 100, premium is 4. The average prices during the option period are determined as follows. So these are the prices. So basically, if I were to take the average spot, this will be 96, 104, 102, 108 and 110 divided by 5. I think this is 104. So call option is the right to buy at 100. So this is 104. At expiry, the spot is 112. So if it is a European option, in a European option, your exercise will be 112 minus 100, which is equal to, let us say, 12. But if it is an Asian option, irrespective of spot at expiry, you will take the average price, that is 104 minus 100. So the payoff will be 4 rupees. So the average price is probably 104. Payoff will be 4. Premium is also 4. So your net profit will be nil. Payoff will be 4. The buyer's net profit will basically be nil over here. So this is the feature of an Asian option. Next, you have binary option or a digital option. So what is a binary call option? Premium is 5 lakhs that you have paid. If the share price exceeds 1000 at expiry, the option pays a fixed 4 lakhs, 40 lakhs. Now, whether the price becomes 1001 or it becomes 2000, what you will be receiving is 40 lakhs. And if the price does not cross 1000, well, the payoff will be nil. Consider the following situation. Spot price is 990. How much do you get? Nil. Spot price is 1020. Basically, it is more than 1000. How much do you get? Sir, 40 lakhs. You are required to find buyer's payoff and net profit. Well, in the first case, the buyer's payoff is nil, but I still have to pay the premium of, I think, 5 lakhs. And hence, at a net level, there will be a loss of 5. In the second case, there will be a net level profit of 35. So there is a net loss of 5. There is a net profit of 35. Look back options. Remember, the major difference between an Asian option and a look back option is, in Asian options, your spot price will be your spot, which is average. But in look back, you can look back and decide the exercise price that you want. So a company purchases a look back call option. The premium over here is 3 rupees, and during the life of the option, the share prices were If it was an Asian one, you would have taken the average of these prices. However, here, I don't know the exercise price only. Well, the exercise price will be the most favorable. So if it's a call option, I would prefer the lowest. So if I review, I believe 79 will be my lowest price, and I can look back and say, well, you know what, based on the prices, I will select 79 as my exercise price. The final spot price is 99. Assuming the holder is allowed to choose the most favorable price, exercise price will be the lowest. If it is call, highest if it is the put. So this is 79. Payoff will be 99 minus 79, which is equal to 20. And the net payoff will be 20 minus a premium of 3, which is equal to 17. So it is basically, if you understand the concept, no, the solution is very easy. But for that, you should know what these terms mean and not be confused in that. Okay, next we have exotic options. For the other options, we have tried to just formulate, let us say, an identification rather than having a numerical for everything. The risk manager comes across the following OTC. OTC is over-the-counter derivative contracts. What is the appropriate exotic option here? The investor can decide after 1 month whether he wants to treat it as a call or a put. So these are chooser options. Option becomes active only if the exchange rate touches 92 during the contract period. I would say this is a barrier or a knock-in option. It will only start if a particular price is reached. Underlying is a portfolio of Nifty rather than a single. Well, these are called as basket options. Maybe something like this can come in an MCQ. Option can only be exercised on 31st March, June, or maturity. These are Bermuda options. Payoff depends on the difference between the Brent crude and WTI crude prices. Well, these are spread options. Your payoff depends on the difference in these prices. And buyer purchases an option, giving them a right to purchase another option after 3 months. These are called as compound options. So over here, these are the various options, and maybe you can be given a case on these lines, and any 3-4 choices may be given, and you might have to select one of them. This will help you in that identification. Next, you have barrier options, also called as knock-in options. A company purchases a barrier call option on a share. The strike price is 100, premium is 4, but the barrier level is 120, which means unless that level is reached during the lifetime of the option, this option does not become active only. This was a very important option that got triggered for a lot of these big banks in the global financial crisis of 2007, when the prices changed significantly and a lot of knockout options or knock-in options were activated. Two possible price movements are 95, 104, 109, 115, 118. At the expiry, whatever is the price, we don't care. During the lifetime, the option has to be first activated, and then we can say that, okay, I will do the payoff. If during the lifetime the option is not activated, like the barrier level is not reached, in which case the payoff will be nil. I will still would have paid 4 ka premium, and hence there will be a 4 rupee loss because the level of 120 is not crossed. However, in the second case, you see at 122, the level of 120 gets crossed, and hence the option becomes active at this point. And if it becomes active, then at expiry, your payoff will be 130 minus, well, then the payoff will be done in the usual way. That is 30 minus 4, 26 will be your net profit. So if I just have to calculate the payoff will be 0 because the option never becomes active over here. One can always argue and say at expiry the price is 130, but generally the understanding over here is before expiry the option has to first become active. Usually I would say that preferably I will show at expiry also this price to be 115, so it does not create any confusion. And here the price is 130, let us say. So case 2, the barrier is touched when the price crosses 122, option becomes active, and hence ultimately 30 is the payoff and 26. Okay. Over here, I think this is a question of securitization, which has wrongly come over here. We will update it, but this is securitization. I think question number one of these questions which has come, which we will review. Now, largely this takes care of derivatives, but I would also want from the derivative section to kind of review a couple of things which may come. First is a return on the margin. If let's say a question comes where like futures payoff, we have done various sums. You can compare the mark to market adjustment. That is, if you have bought a futures contract, you will ultimately cover by selling it, the difference between selling price and the cost price into, let us say, the lot size, number of shares will give you your futures contract gain or loss. This is manageable. Like I bought, let's say, Reliance futures at 100. When I go to sell it, the price is 120. So there's a 20 rupee profit. Now 20 rupee profit is per share. One lot has 100 shares. So 20 into, let us say 100, that is 2000. I have bought two lots, 2000 into 2, that is 4000 will be my profit. Okay, however, if I want to find this in percentage, the return in percentage terms, we will say, well, you know what, how much did I invest in Reliance? Well, I bought two lots of 100 rupee of 100 each at the price of 100. So ideally, I would say 2 into 100 into 100, that comes to 20,000. Would I have invested 20,000? Well, not necessarily, because in futures, there is a concept of margin, and hence you might have just invested the margin amount. Let us say the margin is 20%. So ideally, I would have said that I am buying two lots. One lot has 100 shares of Reliance, and my cost price is 100, which means, well, this is 20,000. However, the margin requirement is 20%, which means I must have invested 4,000 rupees only. And now if I find a gain, it is selling price of 120 minus cost price of 100 into, this is for one share, into 100 shares into two such lots. Well, the profit is also 4,000, which means it's a 100% return. Apparently, it appears to be only a 20% return. But if that was a spot market, yes, the price has gone from 100, I must have invested 100 to 120, so it's a 20% return. But in a futures market, usually the return is calculated based on the margin percentage. So it's a fairly simple concept, but if I look at, let's say, one example, and similar examples are there in your study material for stock futures, index futures, whether you've gone long, short, etc. It's not complete. However, it's from the study material only, but there are a couple of things that are missing over there, but you can understand the essence. Going long on a single stock futures contract. Suppose an investor is bullish on McDonald's. People are going to eat junk food, and goes long on one September stock future. Long means buy stock futures contract on MACD at 80 rupees. Let's say the lot size they have not given, but they've solved considering that lot size is 100. So one lot will have 100 units of this stock. At some point in the future, MACD is trading at 96. At that point, the investor sells the contract at 96 to offset the open position and makes a profit. Acha, they have just given you an example, sir. What will be the profit? Well, when I went long, at the rate of 80. And when I cover it, I will sell it. That is the rate of 96. Therefore, the gain or loss will be selling price, that is 96, minus cost price, that is 80. Now, this is for one contract. Now, one contract has how many shares? Let's say 100. In which case, if you take 16 into 100, this will be a 1600 profit. Okay. So this is the gain. Makes a 1600 profit on the position. This example seems simple, but examine the trades closely. The investor's initial margin requirement. Let's say the margin requirement was 20%. They have not given you, but that means 20% of initially 80 into 100 into 1. So if I go to see 80 into 100 into 1 into 20%, this comes to what? 1600. So maybe you would have deposited 1600 of margin on which you are making a 1600 profit, and hence your when you see your return is around 100%. So if I go to see, this is 600 of profit. So you have earned 100% return on margin. So maybe if the question asks you to calculate return on margin, then you will find the gain or loss and then divide by the initial margin that you have invested to find the return on the margin. So this shows the kind of the effect that futures can possibly have on the gain or a possible loss. Okay, then you have these payoff diagrams. We might have reviewed this broadly, but I don't see any diagrams being asked. But in case a diagram comes up and they ask you to interpret this diagram, then you have to be careful. Now, when you're looking at a payoff diagram, what you do is you look at it from the perspective of an option holder or an option writer. Can be for call option, can be for put options. There can be four possible diagrams. First, if I look at a call option holder, for me, if let us say the option will be exercised when spotted expiry is greater than the exercise price. However, irrespective, even if the spotted expiry is lower, I would have paid the premium. So if I look at an example for a long call, X buys a call at a strike price of 40 in exchange for premium of 5. So even if the price is below 40, 5 rupees is my loss. But the moment the price touches 40, I'm at break even. Above 40, even if the price touches 41, 42, 43, the option will be exercised, but I will not make a net profit. At 41, my payoff will be 1, but I still have to pay a 5 rupees premium, a 4 rupee loss. At 42, also, I would get a 2 rupees payoff with a 5 rupee loss, a 5 rupees premium, so 3 rupee loss, till the time I touch 45. At 45, my payoff will be 5, my premium will be 5, my net payoff is 0. And beyond that, when the price touches 46, 47, 48, maybe 80, maybe 90, maybe 100, maybe 400, the profit will keep on going up and up. So the diagram will show that for an option holder, a call option holder, the maximum loss is 5 rupees. That is the premium amount till the time spot equals exercise price. Beyond that, there will be a profit till the time you touch 45 and you'll be at break even. And beyond that, the profit potential is unlimited. So when you look at a long call, till the time of 40, you see there's a 5 rupee loss. So this is a profit or loss. The moment you cross 40, you will make a gain till the time you touch around 45, where you'll have no profit, no loss. However, beyond that, the profit keeps on going up and up. If you look at a short call for the same situation, the diagram will be opposite. Well, they will have a 5 rupee profit till the time the price is 40. Why? Because after that, till that time, option will not be exercised by the holder. Now you are a writer. Now after that, the holder will exercise, which means for the writer there is a loss, and this loss can keep on going. There's no limit to that. And as a result, in case something like this comes, payoff for a call seller, you will just say that, well, 5 rupees is the loss till the time of 40. So the maximum gain for an option writer is the premium amount, but the loss is in a way unlimited. For a holder, the maximum loss is the premium amount, but the gain over here is in a way unlimited. This is for a call. A similar situation will also arise in case of a put, where put will be exercised if the spotted expiry is less than the exercise price. But if the spot goes above, well, then the option will not be exercised, but you would still have paid the premium, and hence all else remaining constant. It is the same example. The diagram is slightly opposite. So they might give you a diagram like this and say identify. They will give you 4 possibilities. They'll just give you a diagram like this and say identify that this is the payoff diagram for whom: a long call, a short call, a long put, a short put, and you have to select the MCQ. That's about it. So we'll say, well, you know what, this is a situation where the loss is capped at the premium. So for sure, this is a long contract, because if it is a short contract, the whether call or put, the loss is not capped at the premium. So this is long. So, but is it a call or a put? Well, there is a profit when the spot price is lower. When the spot price keeps on going lower, there's a profit, and this usually happens in case of a put, and hence this is a long put. Sir, what if it is a short put? Well, if the price was above 40, as a put writer, I'll be happy that the holder will not exercise. See, the holder will only exercise if the spot is above, spot is below 40. If it is above 40, the holder will not exercise. So 5 rupees is my gain. However, the moment over here, I think this is 35, is a break-even point. This level is reached, that is 40. If the price goes below, even if it is 39, the holder will exercise. Writer will have to pay 1 rupee. It is receiving 5 rupees premium, so there is still a 4 rupees net gain. And if it goes below 35, maybe it goes to 30, then the writer has to pay 10. They have received, let us say, 5. So there's a net loss of 5. So this is for the short put. My point over here is you are not going to be asked to draw the diagram almost certainly. If you are, you can do it. But you may be asked to identify, looking at these charts, which is the payoff diagram for whom, and hence maybe knowing this might be a bit of a help. Similarly, when we look at binomial model, institute, as we say, looks at the risk less hedge. Risk neutral probability is also one of the methods possible. Even for Black-Scholes, what came in the May 2026 paper as well, in the Black-Scholes model, you were asked the Black-Scholes formula, but you were not asked directly to just find the value of call or put. You were told to find, let us say, what is the hedge ratio. Now ND1, which is there in the Black-Scholes, is the hedge ratio. You were asked what is the probability that the option will be exercised. That is actually ND2. ND2 is the probability that the option will be exercised. So maybe you can be asked a bit of detailing, like if they go a bit deeper, that when you look at the Black-Scholes formula, the ND1 represents, let us say, the hedge ratio. That is how many shares for every call option sold. So that is like the hedge ratio, which is like the X or the delta, which you kind of find even for binomial. And ND2 represents the probability that the option will be exercised. So we have just kind of noted that over here. ND1 represents the hedge ratio of the shares of the stock to options, whereas ND2 represents the probability that the price in the spot market would be higher than the exercise price of the call option. Obviously, x upon e raised to rt means the present value of the exercise price and s means the spot price. So this in a way takes care of your section on derivatives. Next, you go to the another important part, which is interest rates. Now, in interest rates, you have quite a few concepts and there are lesser numericals for these concepts. First of all, there is this concept of swaption. Now, what does the word swaption means? As the word goes, it is a swap plus an option, which means a swaption means an option to enter into a swap. Now, swap in case of interest rates may be a traditional fixed for floating swap. So you might agree, let's say an interest rate swap or IRS, where you are agreeing, let us say, I don't know, to pay fixed. This is a payer swap, you call this. You pay fixed and receive floating. But we are saying that I might have a floating rate liability. I am worried that the floating rate of interest will go up and hence I want protection. So I might enter into the interest rate swap, but I only need this if I actually see that the floating rates are going up. If they are not going up, then I don't need this. If the floating rate is going down and if I'm a borrower, I'm more than happy. Now, I may have borrowed money or I might plan to borrow money in the future. You might be worried. So what you might enter into is not a compulsion. Like for example, the floating rate goes down significantly. You are doing your CA. You are very clear that you want to start a business. You will need money. You are clear about everything, just not clear about clearing your CA. But over here, let us say 1 year later, you kind of say that I want to borrow money at the floating rate. But we don't know what the floating rate is. In which case, we say that, well, let us enter into a swap. But if I enter into a swap, then maybe I will pay fixed, receive floating. So I'm losing the benefit which a floating rate fall might give me. But what if the floating rate rises? Well, then this swap can help where I will receive the floating, pay the fixed. However, I don't want to compulsorily commit and enter into a swap. So I want to enter into an option to enter into a swap, which is called as a swaption. Now, people are not going to give you this option free of cost. So obviously they will charge you some premium. However, this is a valuable product in case you want to retain the benefit of a falling floating, but you want protection against a possibility of a rising floating where you can enter into a swap if required. Okay. So when I look at a swaption, XYZ plans to borrow 100 crores after 6 months for a period of 3 years on a floating rate basis. But the management is concerned that the rates might increase before the borrowing is arranged. Okay. To hedge for this uncertainty, the company purchases a payer swaption. Payer swaption means if required, you will pay fixed and receive floating. But this is a payer swaption, not a payer swap. So it's an option to enter into a swap with the following terms. Notional principal is 100 crores. Again, swaption premium is 1.2% of the notional principal. So this is 100 into 1.2%. Maybe this is 1.2 crores, which has to be paid upfront and is non-refundable. The strike fixed rate under the swap is 7%, which means if need be, I will end up paying a fixed amount at 7%. The settlement on exercise is through entering into an interest rate swap. So if after 6 months you decide that I want to enter, then I can enter into the interest rate swap. Ignore discounting, clearly given to you. So time value has to be ignored. At the expiry of the swaption, that is after 6 months, the prevailing market fixed swap rate is 8.4%. Okay. So maybe the rate has gone up to 8.4%. So if I don't enter into this, if I don't exercise this swaption, maybe the rates have gone up. I'll have to pay a higher amount. So what I will do is I would say that, well, maybe if I entered into a pay fixed receive floating swap after 6 months independently, I might have to pay 8.4%. But under this swap, I'm getting a chance to enter this at 7%, which is 1.4% lower. So that is my net gain, 1.4%. You're required to find whether XYZ should exercise. We will say yes, because the rate has gone up to 8.4. Now you had a payer swaption where you had a chance to pay 7. Here in the market, the rate is 8.4, so maybe the rates have gone up, in which case you are getting a benefit of 1.4%. Should I exercise? Well, yes. Commute the gain arising from exercising the swaption. So on a particular year, I would say 100 into 1.4%. That is the difference between 8.4 and 7. This is 1.4 crores per year. And if it's a 3-year contract, well, probably this gain will be, ignoring discounting, 4.2 crores. What would be the net benefit after considering the swaption premium? Well, 4.2 crores minus a premium of 1.2, which is a 3 crore benefit, ignoring or considering the premium but ignoring time value. What would have been the effective fixed borrowing cost if the company had not purchased the swaption? Well, then probably I would have to pay 8.4%. If I entered into the market to take a loan, I would have probably had to take a loan at 8.4%. Here I am getting it at only 7%. No, but 7% ke upar there may be a premium. Premium is 1.2 crores, but that is for the entire term. So 1.2 divided by 3, approximately 0.4 must be the premium, which is per annum. But to exercise, the company has purchased a payers option, which gives a right but not an obligation to pay at 7. Market rate is 8. So you are getting a chance to pay 7 when the rate in the market is 8.4. So you will, the swaption is in the money and you should exercise. Gain on exercise will be, I think, 1.4%, and annual saving will be 1.4 crores. There are 3 years. The question has told you to ignore discounting and time value. So this is 4.2. Net gain after the premium will be around 3 crores. An effective borrowing rate without the swaption will be 8.4, clear. But with the swaption, this will be 7. But 7 is the cost, plus there'll be 1.2 crore divided by, I think, 100 into 1 by 3. So this is 1.2 by 100 divided by 3. I think this is another 0.4%. So this will be another 0.4%, and the rate will be, I think, 7.4. Okay, effectively this rate will be 7.4%. Okay, so the swaption results in an effectively lower cost as compared to the fact that there was no swaption. Okay, then for managing interest rate risk, there are a few things that you need to know, especially for this interest rate chapter. First is something called as gap risk. Now this had a May 26 exam question as well. That question, again, you can refer from the May 26 video. I think question 4B or 5B, something like that, was this question. Now, on the face of it, the question was completely new, but if you see that question, it is very logical and can be solved. I can fully understand it in a new exam scenario. Something like this is very difficult to kind of connect, but let us say independently, it is manageable. So when I look at, let us say, something like the types of interest rate risk, they mention about a few types. Like there is something called as a gap risk. What do you mean by gap risk? Like you might be someone like a bank where you have interest sensitive assets, like you have given loans. So you have given the loans, so these are assets, and there are interest sensitive liabilities. You have borrowed money, taken the loans, so this is in a way a liability. So you might have given loans of 1,000 crores, you might have taken loans or deposits of 900 crores. So the gap over here is 1,000 minus 900, that is 100. Where the assets are more, so it's a positive gap. And the other way around, maybe the assets are 1,000, but you've taken borrowings for whatever reason, 1,100. In which case the liabilities are more, so there's again a 100 gap, which is called as a negative gap of, for example, 100. So there can be a positive or there can be a negative gap. Now, the question might ask you to figure out whether your company's net interest income will have a favorable or an adverse impact if there's a change in interest rate. Like for example, the logic over here is if you have a positive gap, that is your assets are greater than liabilities and the rate of interest goes up. If your rate of interest goes up, so this is positive for me. Why? Because it's a positive gap. My assets are more, interest rates are going up. It's an interest rate sensitive asset. So floating rate loans, there'll be more income I will get on the asset. So that is positive for me. However, if the rate of interest, let's say in summary terms, if I go to see, if the rate of interest goes down, my assets will earn a lower income and hence my net interest income will fall. On the other hand, if it's a negative gap, that is my liabilities are more than my assets. And if the rate of interest goes up, then it will be an adverse effect for me because I'll have to pay more interest, which is on my net liability exposure. But if the rate of interest goes down, I'll be happy because my cost will fall. Yes, rate is falling. I'll earn less on my assets, but at the same time, I'll pay less on my liabilities and I have more liabilities. So my cost saving will be more than the income lost. And hence, this is on gap. Now, the change in the net income can be treated to be earnings at risk. And sometimes you might be given thresholds that if your net income is changing beyond a particular level, you might need hedging. So this is on gap analysis, which is usually helpful for companies or banks which have assets as well as liabilities. So there is asset and liability exposure. So gap risk arises due to mismatch between rate sensitive assets and rate sensitive liabilities with respect to their maturities. It measures the sensitivity of a bank's net interest income to changes in market rates. And this is the same thing that we have kind of tried to tabulate is written over here. This is gap risk. One question on that we will do. Then there is something called as basis risk. Now this is a little difficult to comprehend without doing a number. A basis risk over here would represent occurs when different interest rate benchmarks do not move by the same magnitude, causing unexpected changes in net interest income. Sir, we are maybe your liabilities are benchmarked to a different rate, like for example, MIBOR, but your assets are benchmarked to a different rate, like for example, the prime lending rate. Now, both of them don't move in the same proportion, like your prime lending rate changes by 1%, but your MIBOR changes by, let's say, 0.5%. Then there is a gap. That gap is called as the basis risk. Now, I would say that for these two, maybe we will do numericals and then go further. Otherwise, it is difficult to kind of comprehend what is being said. So we'll go to question number 47 first. A bank provides a more detailed, I would say, question is a May 26 exam question. So you can refer that from the May 26 exam video. But as a concept, a bank provides the following information regarding interest sensitive assets and liabilities. The maturity bucket is given and interest sensitive assets in rupees crores, interest sensitive liabilities in rupees crores. So in the 0 to 6 month bucket, 850 are the assets, 980 are the liabilities. So basically there's a net negative gap of 130. The liabilities are more. Here in 6 to 12 months gap, well, the assets are more by 80 positive. And in 1 to 3 years, again, the assets are more by 150. So compute the gap for each maturity. So we have found that. Identify whether the bank has a positive or a negative gap. Well, in the first bucket, it has a negative gap. In the other two buckets, it has a positive gap. If the market interest rates increase immediately, okay, that means there would be a higher cost in the first bucket where your liability is more. So this will be a loss. And for the other two, I would say the assets are more. So at a higher interest rate, my income will be more than the cost on the liability. So there will be a gain. Explain the likely impact on the bank's net interest income. So as we see over here, negative gap generally reduces the net income. So in the 0 to 6 month bracket, and positive gap improves the net income over here. If there's an interest rate increase, this is the 6 to 12 month bracket and even the 1 to 3 years bracket. Okay, then you have question number 48, which is on basis risk. This is a little more interesting. ABC has the following interest sensitive portfolio. Well, floating rate housing loans of 500 crores linked to repo rate plus 2%. Floating rate deposits. So maybe this is the bank. So these are housing loans. So this must be assets for me. Whereas deposits that these banks take will be liabilities. Remember, this is for the bank of 500 crores, which is linked to the 1 year MCLR. So maybe this is some other benchmark. Initially, the repo rate is 6% and 1 year MCLR is 7%. So my liabilities cost me 7%, but the assets are 6 plus 2, earning 8%. So I have a good 1% net interest income. So on the assets, I will earn 8. On the liabilities, I will pay 7, a net 1% net interest income. Therefore, the loan rate is 8 and deposit rate is 7. They've given you, even if not, we would have calculated this. After 6 months, RBI increases a repo by 1%, which means your assets will now earn, your assets income will increase by 1%. That is, it will now become 9%. But due to competitive pressures, the bank increases the 1 year MCLR by only 0.4, which means uh, the deposit rate will go up by 0.4. So this is 7.4 will be the rate for the liabilities. Now initially the gap was 1%. Now the gap or the difference is around 1.6%. This is because these different benchmarks. See, earlier when we did traditional gap analysis, we said that, well, when interest rate changes for asset and liability, they will change by the same proportion, which is not necessary. Your asset and liability may be benchmarked to a different rate, and hence uh, we will have to study the nature of the gap over here, which is 1.6%. So the basis, this is called as the basis risk. That the basis is the difference. Like if you remember, in case of currency or in case of derivatives, the difference between spot and futures, that was the basis. In a similar way, the difference between the let us say liability rate and the difference between the assets rate can be taken to be the basis. So the basis, which was earlier I think 1%, now is 1.6%, but this is favorable for me because my assets are earning 1% more, my liabilities I'm paying only 0.4% more, and hence the widening of basis from 1 to 1.6, that is 0.6%, is a favorable change in this case. It could have been the other way around, where the asset increases by 0.4 only, the liability increases by 1, in which case this would be unfavorable for me. So the loan rate becomes 9, whereas the deposit rate becomes 7.4. Calculate the net interest spread before. The spread was 1% before, and after 1.6% after the change in interest rate. Calculate the change in net interest spread. I would say this is 0.6%, which is the change. Identify the type of interest rate being illustrated. This is the basis risk. This is the fact that, see, if both of them had changed by 1%, assets also gone up by 1%, liability also gone up by 1%, my net interest income would still remain the same. My net interest income will not change. For a bank, the most important thing is the net interest income. It will not change. Sure, but rate has gone up. Asset is also gone up by 1%. Liability is also gone up by 1%. So unless there was a gap between asset and liability, there would be no impact. But here, whether there's a gap or no gap, the fact that the basis is changing, there will be an impact. In this case, there will be a favorable impact. Why? Because for me, my assets are earning 1% more, but on my liabilities, the cost, so my income is going up by 1%. My cost is going up by only 0.4%. So 0.6% is the favorable change for me. So if I go to see, the net spread initially is 1%. After this, it becomes 1.6%. Change in spread is around 0.6, and this is the basis risk. The nature of the basis shift, since the lending rate has increased more than the deposit rate, the net interest spread has increased. This is a favorable basis shift. So this is a risk that the bank bears. First is the risk of the gap between asset and liability, which will result in maybe a gain or loss. Second, even if there's no gap between assets and liabilities, the fact that assets may be priced using a different benchmark, a liability might be priced using a different benchmark, and hence the differences in that can result in another risk. On these, numericals can be formulated. Now, there are a few other interest rate risks on which numericals may not be formulated, but it can be applied as a part of a case. Like, for example, you'll have embedded options risk. What do you mean by embedded options risk? Like most of the loans, a lot of, at least these long-term loans like housing loans, have a option like a prepayment option inside it. So if, let us say, the market rates, for example, change, there's a possibility that these loans may be prepaid. If they are prepaid, I will receive that money earlier, which is good because I'm getting the principal. But when I go to reinvest it out somewhere, maybe I can reinvest it at a different, maybe at a lower rate. So over here in embedded options, there is a risk that there is a prepayment option available. So maybe money may be received early than what I expected. So that is an embedded option risk. Further, like interest rate risk, the two most common parts of interest rate risk are price risk. As interest rate increase, bond price will fall, or when interest rate decreases, bond price will rise. So as the interest rate changes, the bond price changes. This is called as the bond price risk. And there is a reinvestment risk, which is opposite of the price risk. Like if the interest rate increases, bond price will fall. But if interest rate increases, the coupons that I will get from the bond or cash flows that I will get from the bond, I can reinvest at a higher rate. So that is good if for reinvestment, but if the interest rate decreases, well, the bond price will rise. So that is good from a price perspective, but the money that I will get from the bonds, I'll have to reinvest at a lower rate. So reinvestment is kind of, these two are opposite movements, and hence if you remember in bonds we used to do immunization to kind of balance this out, where you try to equate the duration of assets and liabilities. This is a way to manage the price risk as well as reinvestment risk. So this is bond prices and reinvestment amount. Now yield curve risk is different maturities across the yield, like we would have studied yield curve, where maybe it's an upward sloping, downward sloping, flat. Different maturities might have a different, let us say, rate, and it is possible that the rate changes across different maturities are different. That is called as a yield curve. It results from the shape of the yield curve. So these are usually arising from a non-parallel shift in the yield curve is what they actually say. Like for example, if today my yield curve is at something like this, if it increases at the same maturity, the rate increases, well, that's okay, that is interest rate risk, the rate is going up. However, the increase is much more for a longer maturity as compared to a much more shorter increase for a, so this is due to the shape of the yield curve changing. The longer maturities become a lot more uncertain. So this is called as the yield curve risk. So for these, I would say maybe just trying to understand this using a MCQ or a case would be sufficient in case something like this kind of comes up. So you'll have question number 49. A bank's risk management committee reviews the following independent situations. Identify the most appropriate type of interest rate risk in each case. Home loan borrowers prepay their loans after market interest rates fall and refinance the loans at lower rate. This is embedded options risk, interest risk, because there is an embedded prepayment option. A bank sells long-term government securities before maturity after interest rates rise, resulting in a capital loss. This is the price risk. As the interest rate rise, bond price will fall, and this is the price which is falling. Coupon receipts from bonds are received when market rates have fallen, forcing the bank to reinvest at lower risk. This is called as a reinvestment risk. uh, Make a small change, a non-parallel upward shift in the yield curve reduces the market value of almost every bond. Now this is the yield curve risk. So there is a shift, but it is non-parallel, so then it is yield curve risk. Loans linked to repo rate, while deposits are linked to MCLR. During the year, repo rate increases much more than the MCLR. Well, this is the basis risk. So maybe, like exotic options, these are terms that earlier you would find it difficult to comprehend. Now also they are slightly difficult to comprehend, but maybe it can give you a better sense of uh, how these terms are to be approached. Okay, next you look at swaps. Now within swaps, the every question that is there in the interest rate chapter is mostly for something what is a plain vanilla swap. What do you mean by a plain vanilla swap? A plain vanilla swap will be a traditional uh, fixed for floating. It's a simple fixed for floating swap. There will be one party who has a fixed exposure, wants to swap into floating, another party which has a floating exposure wants to swap into a fixed, and they will enter into a fixed for floating swap. This is called as a plain vanilla swap. However, there can be other types of swap, like we have what is called as, what is plain vanilla swap? Fixed rate payments for floating rate payments. Almost every sum, this is the most important one, and you would have done multiple sums on this, and multiple sums have also come. But there are other types of swaps as well, which is called as a basis rate swap, asset swap, amortizing swap. So we'll quickly understand what each of these terms mean. First of all, we have basis rate swap, where both parties have floating rate exposure only. However, that floating rate exposure is linked to different benchmarks. Like we had, one is at MCLR, one is at repo rate, or one is at a 1 month uh, SOFR, one is at a 6 month SOFR, and you are entering into a swap for that. So that is a basis rate swap, where you are exchanging floating rate payments based on different benchmarks. So like you had that basis rate risk, to manage that basis rate risk, you might enter into a basis rate swap where, like in a plain vanilla swap, you have a fixed rate at one side, floating rate at the other side. The important differentiating factor in a basis rate swap is you have floating rate at both the sides. Just that floating rate is different. You will say that floating rate both sides, which means you are paying floating, receiving floating, but you are paying floating maybe based on a 1 month SOFR, while you are receiving floating based on a 3 month SOFR, and or it may be MCLR or something else. We'll do a numerical. Further, there is an asset swap on which there's one question in the equity, I think derivatives, or where what you do is you are currently holding, let us say, a portfolio of bonds, but you believe that now share market is going to give a very good return. You are with the portfolio of bonds. So what you can do is you can get hold of a party who wants fixed rate returns, and you say, okay, I will pay you what return I'm earning from the bond fix, I'll pay you. However, you may be holding an equity portfolio. Whatever equity returns you get, you will pay me. Well, if the returns are high, I will gain because I will get the equity returns. But if the returns are low, I will have to pay them the fixed return on the bond plus compensate for the returns of equity. So this is called as an asset swap, where we are trying to change the nature of the asset only. See, in a plain vanilla swap, it is loan against loan. One is fixed loan, one is floating loan. In a basis rate swap, it is against a floating rate loan on a different benchmark, against a floating rate loan on a different benchmark. But in case of an asset swap, you are exchanging, let's say, the returns of a bond portfolio, let's say fixed income asset, against an equity return or a crude oil return or return of some other asset. So maybe an asset swap is the exchange of a fixed return from a bond or other similar asset for a floating rate return linked to a benchmark, which can be a Nifty, which can be oil price, it can be anything. It's an asset swap. And then there is an amortizing swap. What does an amortizing swap mean? An amortizing swap means that there is a loan and that loan amount is falling. Now, typical fixed to floating swaps, plain vanilla swaps, will have a notional principal of 100 crores. They will continue payoff at each term at 100 crores. However, it is possible that your actual loan is getting repaid, maybe 20 crores each year. Then ideally it is more advisable to enter into an amortizing swap, where in the first year the payoff will be based on the notional principal of 100, second year it will be based on the notional principal of 80, then 60, then 40, then 20, and so on. So an amortizing swap is an interest rate swap where the notional principal gradually reduces over the life of the swap. And as we said, swaption is an option to enter into an interest rate swap at a specified future date on predefined terms. Okay, so we'll try a couple of questions on this and see if we are able to understand. Question 50, we complete our half century here. So XYZ mutual fund holds 100 crores in corporate bonds. Okay, paying a fixed coupon of 8%. So every year I will get 8% of 100 crores, that is 8 crores. The fund manager expects equity markets to outperform. Now, it's not compulsory they have to outperform. This is my expectation. The fixed income investments, and therefore enters into an asset swap. That is, I will pay the fixed 8 that I'm getting, and I will receive, let us say, exchange for the return on Nifty. I will receive the Nifty return. Okay. Now bond coupon is 8%. Nifty return comes up to be 12% on the notional principal of 100 crores. That means I will receive 12. I will pay 8. So there's a net gain of 4. But this is an asset swap because I'm not exchanging a pure fixed interest to a floating interest. I'm exchanging fixed on a bond portfolio against a different asset class itself. Calculate the annual return from the bond before the swap. So 8 crores, 8%. Determine the annual return after entering into a swap. So 8 plus I will receive a net 4. So maybe 12 rupees. So this is 8 crores under the swap. I will get 12. So a net 4 additionally I will get. Explain why this arrangement is classified as an asset swap. Because I continue to own the bond but exchange my fixed coupon for a return on a market index, which is a different asset class. So this is why it is called as an asset swap. Okay. Next you have question 51, which is an amortizing swap. ABC has borrowed 120 crores through a term loan. The outstanding principal reduces as follows. So in the first year, and then maybe 20 is reducing. To hedge the interest rate risk, ABC enters into an amortizing. interest rate swap. It is the same as plain vanilla swap, just that the notional principal keeps on reducing. That's about it. At a fixed rate of 7%. So maybe I will pay fixed, receive floating. Calculate the annual fixed payment under the swap. Well, in the first case, this will be 7%, 7%, 7 and 7. So maybe 120 into 7% comes to 8.4. 780 into 7% comes to 5.6, maybe 4.2. Okay, 8.47, 5.6, 4.2. Explain why amortizing swap is more appropriate than a plain vanilla swap. Well, because the principal is falling. Had it not been falling, then the plain vanilla swap is good enough. But here the principal is falling. Since the loan principal declines every year, the swap notional also declines. Therefore, the hedge matches the reducing exposures and it kind of avoids over hedging. Then you have the basis rate swap. Similar to that basis rate risk, ABC has a floating rate liability linked to 1 month SOFR, whereas assets on a return linked to 3 months SOFR. So basically, I'm having a floating rate liability. I'm also having a floating rate asset, but they are based on different floating rates. To reduce this mismatch, it enters into a basis rate swap where notional principal is 200 crores, 1 month SOFR is 5.8 unless given otherwise per annum, 3 months SOFR is 6.2 unless given otherwise per annum. So what is the swap terms? I will pay 1 month SOFR, which means I will pay, let's say this is for 1 month, but let's say settlement happens 200 crores into 5.8%. Now depend how many settlement is happening, half yearly, quarterly, monthly, I don't know. Receive 3 month, well the 3 month is 6.2%. Calculate the annual payment. Okay, so annual payment over here will be 200 into 5.8% comes to I think 11.6, and receipt will be 200 into 6.2%, maybe 12.4. Net settlement, I will receive a net 0.8. This is receive. Why is this called as a basis rate swap? Because you are having two floatings and the swap is against, it is not exchanging against a different asset like equity, and it is not even plain vanilla because it is not fixed against a floating. So this is 11.6, 12.4, net 0.8. Both legs are floating rate payments but are linked to different benchmarks like 1 month SOFR and 3 month SOFR, and hence this is called as a basis rate swap. Okay, next you have this question where you are just supposed to identify the type of a swap, where the appropriate type of swap in each case in independent situations. A company has borrowed at a fixed rate but expects interest rates to fall. It enters into a swap under which it pays the floating rate and receives fixed, plain vanilla. It's a simple, like vanilla is the most simple ice cream, plain vanilla. A bank exchanges payments linked to 1 month SOFR with payments linked to 3 months SOFR. This is a basis rate swap. A mutual fund continues to hold a fixed coupon corporate bond but exchanges its fixed coupon for return on the Nifty. This is asset swap. And a company has a reducing term loan and enters into a swap whose notional principal reduces every year. This is called as an amortizing swap. The objective of discussing this is to ensure that if it comes in an MCQ or a case, you should be able to solve. Now, largely this kind of takes care of this section. However, what we have done is we have tried to, even chapters like securitization or startup finance, which are essentially theory, and we have always seen theory questions on them only, but we have tried to identify places where there can be a question like on mechanism of securitization. I hope that you would have the basics of securitization in place, and maybe we are looking at, let us say, the numerical part, and maybe in case of startup finance, well, one of the most important thing over here is let us say, what is a startup, and maybe identifying in case of a particular situation where this is an eligible startup under the scheme of the government or not. So we have a case for that so that you apply that and you will never forget over here. So let us discuss. Okay, we have startup finance, so let us first discuss startup finance and then we go to securitization. So when you want to see whether there's an eligible startup or not, well, first of all, it has to be a entity which is incorporated. It can be a company, it can be an LLP, but it has to be incorporated. Secondly, its turnover should not, in the last 10 years, should not it okay, that is it. First of all, it has to be incorporated. Secondly, it has to be less than 10 years old. It cannot be incorporated beyond 10 years. Otherwise, a legacy company in which is formed in 1950s by your great grandfather today cannot claim that it is a startup. It is a very old company. So it has to be less than 10 years old. That is the second condition. Third is turnover should be less than 100 crores. If in any of the years which are under contention, if your turnover is greater than 100 crores, it cannot be, it is, you are big enough and you don't really need government support for under the Startup India scheme. So you are, let us say, not going to be taken as a startup. uh, Next, you should not be formed by a demerger or a restructuring. Otherwise, what will happen is there is an old company, they want to take the benefit of a startup scheme, they will do a demerger and form a new company and say that this is a startup less than 10 years old. No, it cannot be formed by a demerger or a restructuring. And lastly, it should be doing something which is innovative, generating employment and solving an important, or let's say a technical technology, it has to be technological driven and solving some problem. If you're just opening a small shop and buying and selling, it may be incorporated, it may be less than 10 years old, no restructuring, but you're not doing something which involves innovation or technological implementation significantly, and hence you cannot be called as a startup. So this is, let us say, the thing. So in loose terms, for an entity to qualify as startup, it has to be registered as an LLP company, whatever works in India. You will not take the US company over here. Incorporated within the prescribed period of 10 years. It has to be less than 10 years old. Turnover has not exceeded 100 crores, and you should be working towards innovation, etc. Not formed by splitting up or reconstruction. So this answer is given from the perspective of this question. But these are the 4-5 important conditions. So let us review. Now, ABC Ventures LLP was incorporated in India on 15th of April 2018. So it is in India. It is incorporated 15th April 18. It is developing an AI based inventory management software for MSME. So I'm trying to use innovation or technology, so that is also being met. The following information is available. It is registered as an LLP. You have been given these turnovers, but here this is 108. The business has been developed from scratch and has not been formed by splitting up or reconstruction. The entity is engaged in developing innovative AI-based software products with significant employment generation potential. So it seems most of the conditions are being fulfilled. First, determine whether ABC Ventures qualifies as a startup under Startup India scheme as on 31st March 2023. Okay. So I will look at 31st March 2023. Over here, it is formed in 2018. So it is less than 10 years old. It is incorporated in India, maybe as an LLP, as a company, that is fine. Before 31st March 23, its turnover has not crossed 100 crores. Later it has, where it will no longer now be a startup, but on 31st March 23, it can be very well said to be a startup, because in none of the years has the turnover crossed. Again, it is not formed by splitting up, and I would say this is, yes, eligible startup. Assume all factors remaining unchanged except for the turnover is 108 crores. Will the entity continue to qualify as a startup? The answer is no, because the turnover is crossing 100 crores in any one of the year. It is no longer eligible as a startup. Assume the turnover never exceeded 100 crores, but it was incorporated on 15th of April 2013, and the eligibility is examined on 31st March 25. Now this is more than 10 years old, and hence it will still not qualify as a startup. Assume all conditions are satisfied except that the entity was formed by demerging the software division of an existing company. Now, no matter what the age is, this will not be taken to be an eligible startup. And lastly, assume all other conditions are satisfied, but instead of developing innovating products, the LLP merely carries out wholesale trading of electronic goods without any innovation or scalable business model. Will it be qualified? No. This is a little subjective, this condition. Other all conditions are quite objective. Should be less than 10 years, turnover cannot cross 100 crores, incorporated in India, not by splitting or demerger, but maybe whether I'm actually doing innovative products or not is a bit subjective, and hence you will have to submit an application, and based on that will be assessed. But maybe here, as it is clearly you're just buying and selling electronic products, it cannot be considered. So in the first case, yes. In all other cases, due to various reasons, we will say no, they cannot be taken as a startup. Okay, next you have this couple of questions on securitization. Typically what happens in case of a securitization is there is kind of this pool of loans which is there with, let us say, a company, a bank, which they transfer to a special purpose vehicle or an SPV. In return, the SPV will pay an agreed amount at the start depending on the credit worthiness of these loans, and the SPV will now be responsible for collecting money. But how will the SPV arrange funds to pay off, let us say, the first company? The SPV issues certain instruments like a pass-through certificate, also called as a PTC, or a pay-through security, where whatever money is collected in a pass-through certificate, you transfer that money immediately. You transfer that money immediately without material delay to the investors. In a pay-through security, you collect that money, you use it for some period, you deploy it, and then at specified designated dates, you pay it. So this is a pay-through security. So various instruments can be used. Again, there can be various participants, like there can be a credit rating agency who's uh, kind of giving a credit rating. There can be a bank who is giving, let us say, a guarantee, so that is a credit enhancer. So various things over here can be there, and the SPV can charge certain fees for collecting the money. That is why it is in this business. So there may be certain fees and charges. So considering that, maybe a small numerical to explain the mechanism of securitization. ABC Finance provides vehicle loans, like it's a bank. It has a pool of 1,000 vehicle loans having an outstanding principal of around 50 crores. 1,000 vehicle loans with an outstanding principal of around 50 crores. Okay. The company decides to securitize the entire pool. That is, you sell it to an SPV so that they get an immediate cash. The following information is available. The SPV purchases a loan at 49 crores. So this will be 49 crores. So there is ABC, there's an SPV. ABC will transfer the loans, and in return, the SPV will pay 49 crores to ABC. SPV issues pass-through certificates worth 49 crores. So from the investors, the SPV issues PTC pass-through certificates and it will receive 49 crores. Okay. During the first year, borrowers pay. So now the money will be collected by the SPV. The borrowers pay a principal of 6, an interest of 5. So maybe SPV has collected 11, and this 11 ideally will be from the borrowers, will be passed on to the investors. Okay, but servicing fee payable is 1% of collections. Trustee fee is 10 lakhs. There are no defaults or prepayments during the year. So maybe these are charges. Okay, you're required. How much does ABC Finance receive immediately upon securitizations? I guess 49 is what they are going to receive. Calculate the total collections received by the SPP during the year. Well, 6 plus 5, maybe 11 are the collections. Calculate servicing fee, which is 1% of the collection. So this is 1% of 11 crores, which comes to what? I think obviously it is 0.11 crores or 11 lakhs. Then there's a trustee fee of 10 lakhs. So this is 0.1 crores, and the net amount available for investors. So maybe 11 minus 0.11 minus 0.1. So maybe 10.79 will be flowed through to the investors. So you will, after deducting the necessary charges, you will pay this to the investor. This is agreed. Briefly explain how this transaction improves liquidity position for ABC Finance. Well, this transaction will result in ABC getting immediate liquidity of 49. The risk of these loans going out of its balance sheet, and uh, uh, maybe it can have this capital which can use for other purpose. It can focus on its core business rather than focusing on collections. So ABC will receive 49. Collections are 11. Servicing fee is 11 lakhs. Trustee fee is 10 lakhs. Total deduction is 21. And the amount which will be passed on to the investor is 10.79. ABC converts the illiquid receivables into immediate cash. Yes, maybe instead of 50, I'm getting 49, but well, I'll get immediate cash without increasing borrowings. The receivables move to the SPV, improving liquidity and allowing ABC to deploy funds into fresh lending so that 49 can be used. And uh, that is the main objective. Now 55 over here is a bit incomplete. Actually, point C, point D, and the solution I think is at the end of derivatives. I will update and share an updated file, but even if you have an older file, that is not a problem. You can just go back. My apologies for it. Just bear with me a bit. So over here, the remaining part of this question, I think in this page 50 or 51 approximately, will be there. So maybe around page 50/51. This would be there. So we'll review that. This is a theory part. Sunrise Housing Company has an accumulated home loan receivables of 600 crores. Okay, the CFO proposes the following: transfer all these receivables to an SPV, so a securitization. The SPV will issue securities to the investors backed by these receivables. So there'll be maybe pass through or pay through securities. The existing company will continue collecting EMIs from the borrowers for a servicing fee. So there will be a servicing fee that will be collected. Maybe the SPV can collect or the existing company can collect and charge a servicing fee from the SPV. The investors will receive payments from the actual cash collected from the borrowers. So this is like a pass-through certificate. To improve the investor confidence, a bank agrees to provide a letter of credit that if, let's say there is a problem, the bank will pay. So it's like a guarantee. It's a credit enhancement. A credit rating agency evaluates the quality of the transaction before issue. So there's a credit rating also done. We're required to answer the role performed by the following. Like Sunrise Housing, this is called as the originator. SPV is kind of a special purpose vehicle who is responsible for buying the loans and issuing, let's say, pass-through certificates to the investors. Investors, I think the role over here is they will invest money and in return get the cash flows from the loan. Borrowers are they are the people who are going to pay the interest. The bank is over here a credit enhancer. It increases the, whereas credit rating agency is uh, kind of just going to give the credit rating. So when I look at, I don't know, over here, the first company is the originator, investors, obligators, credit enhancer, rating agency, and finally there's a servicer who is a receiving and paying agent. So I would say this is just identifying nothing much over here. Explain three benefits that Sunrise Housing derives from securitization. The illiquid assets can be converted for immediate liquidity. These loans move out of its balance sheet and it can focus on its core business, can be some of the reasons. Off balance sheet financing, better liquidity, improved financial ratios, focus on core business, lower borrowing cost, etc. Okay, next, I think the other questions are written here only. This is securitization, I think page, I don't know, it's question 55, I guess. Suppose borrowers suddenly begin prepaying the loans because market interest rates decline. Identify one risk faced by investors. Maybe that is a prepayment risk, and that can possibly reduce the overall interest income that they were expecting to receive over the years. Prepayment risk. If instead of immediately paying all collections to the investors, the SPV decides to retain the surplus cash temporarily, reinvest it, and issue securities with different maturities. Which securitization instrument is being used? Pay through security. The typical securitization happens through pass-through certificates where whatever is collected will be transferred without material delay. However, if what is collected is being deployed, used, invested, and then money is paid, that is called as let us say a pay-through security. So a pay-through security, because SPV can restructure cash flows and issue multiple tranches rather than passing collections immediately. Okay, so this is pertaining to question number 55, and I would say this largely takes care of even securitization. Now, in financial policy and corporate strategy, there is a particular question. We have done question number 62 or so. There's just one of our security valuation where you have this question of external funds required. So the formula that we use is, and it is the exact same question if I review, which is there in the study material, where we use something called as the analytical approach, where if you see this question, maybe you will remember it. If you don't, then God save you. Okay, so maybe you might have done this. The balance sheet of Mr. Sundries is as follow. You have some fixed assets, you have some share capitals. Sales was 6,000, expected to grow by 20%. Profit margin and dividend payout ratio are 4 and 50. Company desires that during the year sales to short-term loans and payables should be in the ratio of 4:3. This ratio is 1.5. I'm not doing this again. It's a good question. What are you supposed to do? Find the external funds required and how much should be raised through short-term, long-term, and by new equity. Now, over here, what do you say that, well, usually the business assets, like maybe these are all operating assets. Even the liability over here of payables is operating. But these are providers of capital. These are financing in nature. So we would say that, well, if we want to grow the sales by 20% and unless given otherwise, my assets, which are for operations, will also grow by 20%. Fair enough. And hence we will say that, well, you know what? I have 14,000 worth of assets into 20% if I see, or let's say I'll have to have plus 20%. So over here, this will become, I believe, 16,800. And there will be certain operating liabilities of 2,000 plus 20%. This will become 2,400. So if I look at my assets, my total assets will be 16,800 minus 2,400. So this will be around, I believe, 14,400 initially. So this is, let's say, at year 1. At year 0, they are currently 14,000 minus 2,000, that is 12,000. So maybe I'll have to increase my assets, all of them, fixed assets, inventory, everything, by 20% to reach 14,400. So basically my additional funds required will be 2,400. We have done this. And some of these funds can be managed from the retained earnings that are generated during the year. The incomes that are earned can be reinvested. Like during the year, the sales will now become 6,000 plus 20%, that is equal to 7,200, on which there's a profit of 4%. So maybe this will be 7,200 into 4%, that's 288. And maybe you're retaining 50%, and hence the remaining 144 can be used. So if I want to find external funds, I will say 2,400 minus 144. So minus, I think this would be 2256. So this is 2256, which is the external funds which are in a way needed. I would say this is nothing new over here. However, in the study material, they've added a formula and they've said alternatively, you can do the same question using the formula approach. What we have done and what you might have even reviewed is based on what is called as the analytical approach, where you analyze that this is the additional funds required, etc. However, they say that you can even solve this using what is called as a formula approach. And we are just trying to solve additionally using if a formula approach is asked, or they've just given you data which can be used in a formula only. Like if the same question comes, their main solution is the regular solution that we do. But if they ask you specifically to solve using the formula approach, or they give you data which is only enough where you can use formulas only, then what? Like what is the formula approach? Well, you take turnover ratios. Well, you say total assets upon sales minus the payables or your operating liabilities upon sale. So this is your turnover ratio. What does this mean? It means that for every 1 rupee of sales, how many assets are actually needed? Like in our case, you will have currently 14,000 worth of total assets and there was 2,000 worth of liabilities. So this is 6,000. This is 12,000 for a 6,000 sales. Sir, what does this mean? This means that for a sale of 1 rupee, you need 2 times, that is 2 rupees worth of assets. So for a sale of 6,000 currently, you need at a net level around 12,000 worth of assets. Now you want to increase your sales. So minus delta sales, you want to increase your sales by how much? Well, by 1,200 rupees. You want to increase it by 1,200. Sir, how? 6,000 into 20%, that is 1,200. And hence your total funds required, this is your total funds required, which will be 12,000 divided by 6,000 into 1,200, that's it, 2,400. That is what you found. This is your total funds required. However, some of the funds will be managed using retained earnings. So how will I find that? Well, I will take S1, that is the sales of the period, into the net profit margin, into 1 minus the payout ratio, that is sales of 7,200 into 4%. This will be your net profit into 1 minus 0.5 If I do this working, I will get exactly the same answer. So then why are we doing this? Because in this question, balance sheet, etc. is available. But if the question only gave you certain ratios like total asset turnover, payable turnover, and then said calculate the funds required, then you will be a little bit lost, which you can possibly solve if it comes. It is just an additional working which is there in the study material, which you should be able to apply if required. So like total asset turnover minus payables turnover into sales. So this will give you maybe your total funds required minus net profit margin into projected sales into 1 minus payout. So this will give you the additional retained earnings which can be used, and hence the difference will give you external funds required. That's just about it. So over here, if you go to see 14,000 by 6,000 minus 2,000 by 6,000 into 1,200 minus 4% of 7,200 minus 0.5, it comes to the same answer. Everything else in a way remains the same. So if on similar lines, if I were to try a question, ABC reported sales of 1,000 lakh during the current year and expects to increase the sales by 25%. So your delta sales will be around 250. And your S1, your sales of the upcoming year will be 1250. You are given the following information. Total assets are 700, payables and accrued liabilities are 180. Net profit margin is 6%, dividend payout ratio is 40%. Using the formula approach, calculate external funds required. Like you were asked using H model, like you can actually find, if you see in May 26 that questions answer using a regular present value future cash flow as well, but the question told you to calculate using H model. In a similar way for external funds, they might even ask you to calculate using, let us say, the formula approach. So over here, what you will do is total assets upon sales minus payable upon sales. You can do that as a single working as well, into delta sales, change in sales. So this will give you total funds required. So total assets currently are 700 for a sales of 1,000. Payables are 180 for a sales of 1,000. So basically 520 of net assets are needed for a sales of 1,000. So for 1 rupee of sale, 0.52 of net assets are needed. Now you want to increase this by 250. So how much is needed? Now minus, let's say, net profit margin into sales expected into 1 minus the payout ratio. That is 6% of 1250 into 1 minus 0.4. So if I look at this working, this is what I think 130 of total funds needed, and there is 120, 1250 into 6% into 0.6. This is, I believe, 45, and hence 85 over here would be your external funds needed. Perfect. Now we have done every chapter. There is also one more chapter which is on business valuation, and on business valuation a couple of years back there was a fair bit of theory which was added, where we had solved, and I shared that video on YouTube as well. I will try to link it, let us say, to the file. There's a separate PDF that we have which you can refer if you have not already done, and a separate video on YouTube for this as well. So there is no theory change in business valuation apart from these new topics like valuation of distressed companies, startups. There are various methods like the first Chicago method and the venture capital method and the balance scorecard, and a lot of methods which were there. Distressed company valuation was there, probability of default, etc. Digital platforms, ESG, environmental, social and governance, and we had around 8 to 10 questions to cover this entire part. Now this was 2 years back, and I think 1 or 2 years back, I don't know. And we have a separate YouTube video whose link is over here. If you have not referred that, if you have done this already, and it would have been done in the batches, but if you want to refer it separately, you can refer these parts from that same video, and the notes for the same are also on the drive. Again, I can very well expect something if they have to ask you. There are very interesting methods, especially in case of distressed company, startups and ESG over here, where there can be questions that can come, and that is already there. I will try to link this at the top, and you can try to refer that video as well, and the PDF of this also. We are not just putting it next to this again because it will result in duplication and a bit of confusion. If you want, you can refer this separately, and I now kind of conclude this session where we have discussed these questions, all of these chapters done, all of these questions everywhere we have categorized A and B category, like securitization as well. Uh, so we, at least if you can, like, we have found certain questions like credit default swap, we have put in A category because it has even come in one of the MTPs, etc. So just try to review as much as possible. And if you've reached up to here, even if you've listened to the lecture, I hope that this additional concepts has helped you, at least calming your nerves to some extent. Uh, Remember, there is no end into this search and quest to find new questions. If you have done this along with your core content, you are very well prepared to handle any kind of a paper. Now, in my opinion, the paper will not be as intense as May 26, but let us say if the learnings that we got from May 26, we have tried to do the best we can and incorporate. Now, after this, if you keep on searching for new content again and again, there's no end to it. You can tell, let us say, an AI to generate hundreds of questions, but remember, you have a finite amount of time. So before you go into this quest for finding more and more questions, I would strongly recommend that you draw a line, because otherwise you will just keep on trying to be scared. And will this same thing come? The answer is no. Well, the institute can use these concepts and formulate a question on its own. Our job is to ensure that we try to cover everything which is there on the numerical side as well as on the theory side which is there in the institute, on which a question can possibly come. But is it compulsory that the same question will come? The answer is no. So unless we draw a line, it's like a rabbit hole. You'll keep on going down and down, and you'll feel scared. I want you to feel calm. The entire objective of doing this entire and sharing this view entirely along with the PDF and video is to kind of put an end to your fear that what will happen if some new concept or question comes. Well, we have done the best which we can possibly do. Focus on your core content. Look at this as supplementary and additional material and kind of draw a line over there. Ensure that you mainly ensure that whatever is there in your study material, in, let us say, whatever material you have studied from, you do that properly. And can a new question come? Definitely yes. How will we address the new question? In my opinion, just keep in mind that if a new question comes, you start writing the given data. That is the first thing. Don't start staring at the question and panicking. Be in movement, be in action. Write down the given data. Based on what you write, you will see certain relationships. Oh, maybe EPS is there, maybe P is there. Oh, I can find market price. Oh, I have also have number of shares, market cap. You go put one foot in front of the other. Maybe you will hit a dead end, maybe you will not. But if you keep on seeing and visualizing, the clock will run out, and hence you don't have to let the panic button being pressed. You have to remember that you have 3 hours and you have to make the best of them. Can a new question come? Yes. How will we address it? Step number 1, note down the given data. Step number 2, based on the given data that you have noted down, whatever relationships come into your mind, try to find one thing will lead to the other, and most likely than not, you will come closer and closer. And even if you don't, there will be a particular step that you will reach. Till the time you will get a stepwise marking. And if you hit a dead end beyond which you are unable to solve, see, you can narrow down the funnel. You can come to a place where there's a problem, make an assumption, solve it, and end it, and go to the next question. But if you get fixated over there, I'm telling you, if it is new for you, it is new for everyone else. It does not solve the problem. But remember, if it is different, it is different for everyone. How you apply your knowledge, what you have in those 3 hours matters the most. Don't chase perfection. At least try to complete what is there and try to solve for whatever is whatever you know. You will come closer, but it may not always come that you will get the right answer. And the institute mentions that assumption should be a part of your answer. Working notes should form a part of your answer. You write your assumption freely and try to come to a conclusion and proceed further. But you have given the best. If you have reached this stage of the video, you are already going above and beyond the call of duty. You have completed 3 parts of a topic which you want to learn more, which you want to cover everything. Now beyond this, if this does not give you confidence, I don't know what will. So don't be so hard on yourself. You are putting in so much efforts. Let that be documented well. Let that be done well. The examiner does not know what you have studied, how many times you have revised, what revision you have done. He or she knows what you will write in those papers. So don't let the fear of an unknown question scare you so much that you are not, you know a lot of things. You are one of the few people who have reached up to final C and so close to your exam. So when you are in those 3 hours, try to do the best you can. Maybe some questions will go in your favor, maybe some questions will not. But putting your head down and going into a different tangent is not what we want. We want to be in our movement, and we have tried to cover as much as possible. And I'm sure you have done a fabulous job. You have given so much, you have put in so much hard work, you have sacrificed so much time, and you are very close. You are very, very close to getting your coveted prefix. But uh, uh, ensure that this time that you have before your exam, you use it in the best possible way. I'm sure we are all here rooting for you, cheering for you. All the blessings and prayers, all your hard work will bear fruit. Just hold on, you're almost there. Okay, so with that, I'll wrap up this session and I'll wish you all the very best. I'll see you with more revision videos and more content updates. If you do like this, please press the like button, share it with your friends. It means a lot to us. And keep smiling, keep studying, keep giving your best, and I'm sure your prefix, your CA prefix is very, very close. That's it for today. I'll wish you good luck. Bye bye and take care. See you soon.